It's strange that I went to dental school to inevitably make money, yet was never taught the difference between the two types of income, passive and active income. Now, after receiving my first tax return, it didn't take long to figure out that active income from fixing people's teeth was the highest tax income there was. And I found out much later in my career about how building passive income streams is the key to reaching financial freedom. But you still have to spend your time doing things like treating patients or dealing with customers that is eventually going to lead to passive income in the future. Warren Buffett said it best when he said, if you don't find a way to make money while you sleep, you're going to work until you die. Now, in this video, we're going to discuss the differences between active and passive income, examples of each, and more importantly, what you can do to start turning your active income into passive income. And if you're new here, I'm Dr. Jeff Anzalone, a periodontist that's on a mission to get you out of the rat race. Do me a favor and download the free passive income guide with the link below this video. So let's start off by talking about first, what exactly is active income? As previously discussed, trading time for money produces active income. Now, this can either be in the form of commission, salary, or hourly wage. Too many people are only teaching out there online, YouTube videos about the need for passive income. They're like, you can magically make it appear. Yet, they forget about one key point. You still need active income first to generate passive income. So for instance, if you're a doctor, focus on getting really good at your profession, okay? Going to different CE courses, treating patients well, getting more referrals to increase your active income as much as possible. Because you spent time, energy, and a lot of money, more than likely, to get where you are, and your time is better served doing that one thing. When you start focusing on other things, such as buying real estate on your own and becoming a landlord, your active income, what you spent all your time, money, and effort on, your active income will start to suffer. Remember, if you want to earn passive income from investments, then you first need to invest the money you earn from your active income stream. All right, passive income. So what exactly is passive income? According to Investopedia, passive income is basically earnings derived from rental property, limited partnerships, or other enterprises in which somebody is not actively involved. So in a nutshell, if you're earning passive income, you're doing so with basically little to no effort. You're basically hands off. All of the passive income I've received in the past is from income producing assets that I'm not actively involved in, such as real estate syndications. As we mentioned before, getting these passive income streams still requires work, which comes from the active income. But if you focus your efforts on something that will eventually generate money while you sleep, it's definitely going to be worth the wait. Let's talk about the 5 different types of passive income. The first one is rental income. So income from rental property is treated as passive income for tax purposes unless you're considered a real estate professional. In that case, any rental income earned, it actually counts as active income, but you can also use depreciation to offset your active income to reduce your overall tax liability, which is, of course, one of the main reasons of being a real estate professional. Owning rental property and receiving income from it doesn't feel very passive, as you're still in the point you're still having to deal with tenants. But if you're like me and you invest in syndications as a limited partner, rest assured, as the general partners handle all the dealings that come along with actually owning the property. In most cases, taxes on rental income are paid based on an investor's federal and state income tax bracket, and they generally don't have to withhold any payroll taxes. Number 2, private equity. So private equity actually refers to a group of funds that invest in or acquire private companies not listed on a public stock exchange. They may also buy out public companies, take them private, and restructure them for potential growth. Most private equity investments require high capital requirements and are considered a lot of times high risk. Now, my wife and I, we invested in our first private equity deal about 2 years ago, and it's got the typical 10-year hold period, and it looks to us like it's going to be a good source of passive income for the long term. But what we did, we sat down and we said, hey, look, we're going to take X amount of money and we're going to invest in it. And we were willing to lose 100% of that because it was a more risky investment. And so if you're married, it's really good to get on board with your spouse. Just a piece, that's just a little advice, especially if you're going to be involved with investing with someone else. Number 3, interest made from other investments. So one of the most common ways people earn passive income is the stock market with interest and or dividends. Some examples include REITs, index funds, ETFs, and dividend stocks. Number 4 is owning businesses. Now, if you've been on YouTube recently, you've probably noticed that this is one of the hottest trends out there right now for passive income streams. Basically, going out and buying cash flowing businesses. These can be managed passively, so the owner doesn't need to actively engage in the day-to-day operations. A couple examples include car washes, laundromats, and vending machine routes. Number 5, online courses and information products. Now, my teenage son last year, he was learning some of the best skills from a group that's really going to take him very far in life, no matter what their profession is. That's learning how to sell. So actually, if you have teenagers, you may want to look into this. Cutco Knives, CUTCO, Cutco Knives has a program that actually teaches sales and marketing to students in order for them to actually sell their products. Now, I told him that if he wanted to further his career as an entrepreneur, he could actually teach what he's learning going through this Cutco Knife program to other teens on YouTube, or develop online courses. Really, the sky's the limit, as you know, with the internet. So there's people making really good money out there selling online courses, which eventually turns into a solid passive income stream. You create the course first, you record it, and then you can just sell it infinitely. The key is building an online following, which can be done with the email list or social media platforms. Once you have an audience and you launch a course that teaches a valuable skill, then you could easily make tens of thousands of dollars per month. If you don't believe me, look at how many millionaires right now that are on YouTube that are teenagers. It's mind-boggling. All right, so now let's talk about how to generate income from real estate, active versus passive. So real estate can generate active or passive income, and it's determined by what investment objective you have to generate this money over the short term or the long term. Now, an active real estate investor means that you're taking a hands-on approach. And again, it's going to be more time consuming having to deal with tenants or property problems as they arrive. Passive investing, again, is a more hands-off approach with limited control and time commitments, and it involves much less risk than somebody that's actively investing. Passive real estate investing is great for somebody that's busy, it's a professional, limited time, but they want other streams of income. Actually, the time factor is one of the main reasons I chose the passive route via these syndications, which is nothing more than a partnership between multiple investors, which are the passive investors, which are limited partners, and then the general partners. Now, this group comes together and they share capital, they share skills and other resources, which allows them to gain purchasing power and acquire these properties that they could otherwise afford on their own. The project sponsor is responsible for things such as finding or acquiring the property, obtaining the financing, daily management, and then reporting back to you and I, the passive investor. Income from syndications are generated mainly in two different ways. You have the recurring net income after rents have been collected and expenses are paid. Most of the time, this passive income or distributions, they're paid out quarterly. Some of them are monthly, but most of them are quarterly. That's the first way they pay. The second is from basically the potential profit made from appreciation. This is earned whenever the property or properties sell. Most of the time, this income, again, a lot of this income is paid out quarterly. And this is like a 5 to 7 year hold period. So after the 5 to 7 year hold period, once the property sells, then you've got the profit split, and that comes from the appreciation. Now, one of the best things about owning passive real estate is that an investor can spend as little or as much time as they wish on their business. Now, on the other hand, when active real estate investors stop working, they also stop getting paid. So again, don't take this as financial advice, don't take this as tax advice, but I do want to go over with you how, and this is really important, how both of these types of income are taxed. And hopefully it'll get you to start thinking about, wait a minute, why am I only operating with active income? Because again, it's the highest tax income there is, and actually falls within 7 tax brackets, ranging anywhere from 10% in the lowest tax bracket, and currently now 37% is in the highest tax bracket. Active income is also subject to FICA taxes, which is nothing more than payroll taxes. Depending on if you're an employee or self-employed, you can look at your check. Social Security, 6.2% currently. Medicare, 1.45% currently. If you're like me and you're self-employed, I own my own practice, then you must not only pay this, but you also have to match your employees' contributions. So you actually have to pay 15.3%. So you have to pay double this. So not only pay for them, but pay for you. How about that? So meanwhile, passive income is taxed according to the capital gains rules, which is taxed much less, 0 to a maximum of 20% currently. This allows you to shield income from excessive taxation when you're compared to the ordinary tax rules. Now, one of the reasons that passive income is better than active income, again, it's not subject to these payroll taxes. And passive real estate investors, they get all the tax benefits that an active investor gets. And two of the main ones are, the first one being depreciation. So even though you're not actually performing these landlord duties as a passive investor, you continue to get the full tax benefits because you're investing in an entity, it's typically an LLC, that owns the property. And that entity is disregarded in the eyes of the IRS, sometimes called pass-through entities. And these tax benefits, they pass or they flow through that entity to you, the investor. And one of the most common rental property deductions a passive real estate investor can claim is this depreciation. And basically, this benefit allows real estate investors to write off property over time. This allowance is due to the wear and tear and deterioration of the property. Now, under current law, investors can use depreciation deductions from each year from pre-tax income to recover the cost basis of a property over the calendar years in which they own property. There's actually three types of depreciation. The first one is being straight line depreciation. So property owners, they can depreciate their property. It's called straight line depreciation over 27.5 years. For example, the annual depreciation expense, let's say a single family home of $200,000, if you take that, you divide it by 27 and a half years, that'll actually give you an annual depreciation expense of $7,278. The second type of depreciation is accelerated depreciation. Usually real estate owners, they hire a group of engineers to perform what's called a cost segregation study. Now, this study allows different building components to be depreciated. They actually go in and they segregate out, hence the name cost segregation. They segregate out these different building components to be depreciated over shorter time periods. So instead of 27.5 years, they actually shorten it over 5, 17, or 15 years by identifying the non-structural elements plus any land improvements. So you're looking at flooring is going to wear out, cabinets are going to wear out, appliances are going to wear out. They're going to wear out in the eyes of the IRS much quicker than 27 and a half years. So you're able to accelerate or get this depreciation now, more depreciation benefit up front. As accelerated depreciation, they create these large paper losses in the early years of ownership. So when you get into a syndication, let's say it's a 5-year hold period, you can benefit a lot of times from the majority of the depreciation because they've used the accelerated, or number 3, they've used the bonus depreciation. Now, this will allow investors to front load depreciation even more with less, anything that has less than a 15-year tax life. You can bonus depreciate most of this all in the first year. Okay. So a lot of times you can get the majority of the tax benefits in the first year. Now, as a side note, bonus depreciation currently is being phased out into the year of 2026, unless something, they make another change in the law or anything like that. But even if you don't have bonus depreciation, you can still benefit from the accelerated depreciation. All right. So that's the first tax benefit with passive income. And the second one has to do with the capital gains tax. So whenever you have real estate and it's sold, whether you're active or you have a syndication, you sell it, then the IRS, they're still going to get their cut, right, through something called a capital gains tax. So that's a capital gains after the deal is sold. So the amount of capital gains depends on the length of time that the asset is held, and then your individual tax bracket. Now, in 2023, we're recording this right now, it's anywhere from 0 to 20%. So for instance, if you make $0 to $89,250 a year, you pay 0% capital gains tax. And if you make over $553,000, you're 20% capital gains tax. And you may say, well, 20%, that's kind of high, but look at, if you make over $553,000 a year, look at what you're paying now on that active income. You're paying federal and state income tax, right? Probably close to 50% versus 20%. So gains made from selling assets held for less than a year, those are called short-term capital gains. And those are actually taxed at the same rate as your ordinary income. So the key is holding it for longer than a year, because if you do that, those are long-term capital gains. These are taxed at the 0 to 20%. Okay. Now, sometimes people ask me, why is passive income so important? And really the simple answer that I like to give them is time. Because there's really nothing more valuable than time, because it's irreplaceable, right? You can always go out and make more money, but you can't make more time unless you are in Back to the Future. Passive income is created without you having to be physically present. So if you have a passive income stream established, then you can make money 24/7. But don't misunderstand that building passive income, it can take years to build. It's not like a get-rich-quick thing, right? So there's work that has to be done up front, and for most of this, it comes from earning what we talked about earlier, this active income. Again, if you're a doctor, then you're paid for treating patients. And then you can take that active income and invest in cash flowing assets, generating passive income. All right. You can't be lazy and just expect passive income to magically appear and start rolling in, because nothing in life is easy, right? And you must be willing to put in the work and effort up front. But if you're consistent with the strategy, you could literally end up making money while you sleep. Okay. And speaking of doctors, if you want to know why most of them struggle with money, even though they make a lot of money, then guess what? Check out this video and I'll let you know why that is.